Hi, my name is Andrew. Thank you for visiting my YouTube channel. This is another video in a series on real estate fundraising, and this video focuses on understanding the key financial analysis points. So in this video, we're going to look at how to review the financials in real estate fundraising. So a lot of the details in this video come out of my real estate capital fundraising guide and my due diligence guide. These are two guides that I created for real estate firms to help them with the fundraising process. They're both around 75 pages each, so most of the information from this video comes from the Ultimate Guide to Raising Real Estate Capital. So before we get to the video, this is just a really quick look at the Ultimate Guide to Raising Real Estate Capital. This is a comprehensive guide with absolutely everything in it that you need if you're a first-time fundraising, anywhere from $10 million to $100 million. This is ideal for real estate companies who really want a bit of a guideline of how to manage the process. Absolutely everything in here, from corporate to legal to due diligence, and it's all part of a package that I created specifically for real estate companies in 2025. So before we start, full disclosure, I'm not a financial analyst. I work more on the strategy and marketing and sales end of the real estate specter, but this particular video is really going to focus on how to take a look at financials in a fundraising venture, and it's good for both the fundraising team or the real estate team that's looking to raise capital or maybe even to dispose of assets, and it's also good for someone on the investor side so that they can take a look at what they should look at as well. So basically either party can find value in this video. So let's start off with why financial analysis matters. Well, it's one of the key cornerstones. It's the importance of understanding the financials in real estate deals. I work with a number of private equity groups from time to time, and even real estate acquisitions, large assets over many years in the Middle East, and we always had people who sat and analyzed the numbers. They didn't care about the asset. They didn't care what it looked like. Nothing about that mattered. All they wanted to do is try to match up numbers on a spreadsheet, which is not necessarily the best thing, because you can never really evaluate the value of a building unless you actually go on the ground, look at it, take a look at the area. But their job mainly is to look at the numbers, so that's why you need a number of people on the team to make sure that you're getting the best value on either side. So the impact on investor confidence and project success comes from the financials, and also how risks and opportunities can influence decision making. So let's look at the core areas of financial analysis. So the key financial metrics to analysis are net operating income, or NOI, debt service coverage ratio, DSCR, return on investment, ROI, operating expense ratio, OER, and then your break-even occupancy rates. So those are really the key metrics that someone will look at, especially if it's on an executive summary. It's a good starting point to take a look at a particular opportunity. And then we get into a little more detail on the risk analysis, and this is where the data really is important. So for example, let's start off with identifying financial risks in real estate deals. Number one, overestimated revenue projections. That's really a key one. Unrealistic rent or occupancy assumptions. Now, if I'm a financial analyst, which I'm not, I might just see those numbers and say, hey, they seem a little bit unrealistic. They may not know that the leases are going to be turning over soon. The rates have increased, especially if it's a commercial property. Maybe there was a 5-year lease and the numbers were undervalued, and we're able to acquire this asset and raise the lease amounts up as part of that process. Then the value is going to go up. So everything has to be looked at in true context. Number two, high operating expenses, costs exceeding market norms. Those are ones that I like to see if I'm looking to invest in a property, because that's the first thing I can chop, and either chop on the number of staff or the suppliers of whatever is out of norm. Again, remember, these contracts could have been negotiated 3, 4, 5 years ago. I've seen some cases where cleaning contracts have not changed in 10 years. Number 3, deferred maintenance costs. Those are unaddressed repairs or upgrades. Those are going to be really key to determine, okay, is the investor going to need to pump a lot of money into this project in a couple of years because of products that have aged, and maybe there's all kinds of hidden things that necessarily do not need to be disclosed. If you're trying to sell a apartment building and it's got 100 units, you do not have to disclose that 100 of them, 100 of the occupants are saying, hey, in the winter time our heat's not very good. That's something you may not necessarily need to disclose, but when you get into the inside of the building and say, oh, wow, this HVAC equipment seems to be 15, 20 years old, it's going to be renewed. Those are usually the underlying reasons. Number 4, debt-related risks. That's high leverage or unfavorable loan terms. Those are really easy to see with the naked eye. 5, tenant risks, the dependency on short-term or unstable tenants. Now that's a tricky one because you can buy, for example, an old building, especially right now as we're sitting here in 2025. The world has changed in the last 10 years as far as what people can afford, and the higher the prices of real property, let's say residential, that means less people can actually afford to buy, and they need to be turned into the rental market. Well, what's happening with the rental market? It's done the same thing as the home prices. So what's left are what you would call unfavorable type of living conditions. Rooming houses could fall into that. But let me tell you something. You could buy a house that's 100 years old that used to be a 3-bedroom house that was maybe renting for $5,000 a year in a good, let's say a good market. You could take that, and if it's zoned properly, you could turn that into 10 or 15 rooms that are now making you $500 or $1,000 a month. That's why you have to take a look at tenant risks differently than you may have had to in the past. Just because somebody does not have good credit also does not mean they're a bad tenant. Most people, they pay their rent first before everything else. If you have a building, let's say, that has 10 rooms in it, you're not going to be stuck with that one tenant who is killing you because they're not paying. And believe it or not, all the Landlord-Tenant Act laws tend to favor tenants these days, so it's really hard to kick someone out. Even if you do have cost overruns, inadequate contingency budgets. So on the other side, you have the opportunity analysis. So if you're looking at the spreadsheets and the spreadsheets alone, and you've got good guidance from the rest of your team, spotting opportunities in the financials, below market rents. I touched on that before. There's potential for income growth. That's one of the main reasons why commercial properties sometimes can be really, really good assets to purchase, especially if you're purchasing them before the current contracts are going to renew, because if over time rents go up, and certainly on the commercial end, whether it's business, whether it's shops, whether it's industrial, those things are going to go up. Number 2, you got value-added potential, renovations or repurposing opportunities, as I mentioned in the case of the 100-year-old house. There's all kinds of opportunity to upscale and create more revenue. 3, expense optimization, reducing efficiencies or renegotiating contracts. We see that all the time. Market growth upside, location benefits or infrastructure projects. And number 5, unutilized land or space, additional development options. You take a look at a house, for example. Again, we're using that, for the most of the fundraising, we are talking about buildings mainly, but if I just drill it down to use a house, can you turn that basement that's really no longer going to be used as a real basement for a residential house, can you turn that into 2 or 3 apartments? So now you've got 2 or 3 apartments in the basements, and on the upper levels you have the individual rooms. So you have to take a look at those type of things. And sometimes the person looking at the spreadsheet's not thinking about that because they don't have the experience to be able to do that. So that's why the numbers, when you're doing financial analysis, are not the end and all. So real estate development financials. So here's where most of the focus of what I like to take a look at is key financial focus areas for development projects. You're going to look at feasibility studies, land acquisition costs, permitting, and regulatory expenses. You're going to look at development budgets, construction costs, contingencies, soft costs, legal and architectural. An awful lot of the expense when it comes to real estate development comes way before you even start to market a product. I was involved in one a few years ago. We had 130 units to develop. This was when I was in Canada, and we spent about 9 months, just myself and the developer, because I was the right-hand man on that particular project, just going over the items to get us to opening up the sales office. And you know, you've got the land, and you've got a number of issues having to do with approvals, contracts, start talking about hiring budgets. So that's why a lot of people do not like to get into the development game as far as an investor, because it's the time to just even to get to the sales. Remember, if it took us 9 months to get to opening up a sales office, and then it's going to take another year for us to sell the units, and then another 3 years to develop it as far as getting our cash out when the people move in. So sometimes you're looking at 4 or 5, 6 years. So this is something that's really important. You've got, again, the feasibility studies, the budget development, and pro forma projections. That's income versus expense forecasts post completion. That's if you're going to be renting it out. If you're going to be selling it as condos, it's a little bit of a different scenario. So when you're looking at real estate acquisition financials, so the critical financial aspects of acquisitions, again, touched on this a little bit more. The rent rolls, current tenant revenue mix. I can remember looking at a number of spreadsheets having to do with having 200-300 tenants in a number of commercial buildings. Again, these are commercial, and everyone has a different lease, of course, because they're going to be different sizes. It's a little bit different than analyzing residential, where you're really looking at, you know, 1 bedroom, 2 bedroom, 3 bedroom in a building. When it comes to commercial, you've got people that have 1,000 square feet, 5,000 square feet. You've got people that have full floors, and historical different reasons why they're there. Could be anchor tenants, that sort of thing. Operating statements, you're going to look at all the historical and current financial performance, making sure that if there's any changes in them, that they're explained. You want to also understand that, okay, if there's all of a sudden been a high amount of income, you're going to want to say, well, what happened during those years? And if the current owner says, who's trying to sell the property, says, well, the leases had expired and those are the new leases, and they're 5 years, then I'm going to know somebody on the who's doing the analysis that, okay, those are going to be low growth areas for me, but behind it we've got another, let's say 40-50% of the building that's going to be renewing next year, and those are the ones you're going to capitalize on. Lease agreements, future rent escalation and terms. Again, this is probably the most important part when you're buying anything that is residential, as far as larger projects. Appraisals and market comparables, assessing a fair market value. Some of this is stuff that you're going to outsource. Certainly appraisals you're going to usually outsource to a party that has a lot of excellence and a good reputation when it comes to that aspect. So let's just take a look at this on a chart basis. Risks and opportunities in the financials. So you have the financial aspect, the potential risk, and the opportunity. So revenue projections, again, we just covered a lot of this. Overly optimistic assumptions. Well, what's the opportunity? Conservative projections with upside potential. Again, when the leases end up need to be renewed, hopefully the market's gone up as well. There's also downside risk in that. Operating expenses, inefficient or excessive costs, versus the opportunity would be streamlining operations to reduce costs. Almost always that's the case where the new party comes in, because when an asset is going to be sold, almost all the time the person that's operating has to take that. It's a risk for them to change what's already in line as far as the servicing. And it's almost better to just leave it as and say to the new party, hey, you're going to be able to move all those guys out and make money on it. It's a good selling point for you. Tenant leases, again, short-term agreements or unstable tenants versus long-term leases with credit-worthy tenants. Debt terms, on the potential risk side, you've got high interest rates or unfavorable loan conditions. The opportunity is low interest fixed rate loans. It's a funny balance happening right now with loan rates and mortgage rates is because of the economic situation in the past few years. We've seen interest rates go up and down, and now they're at a point where they seem pretty favorable if you're looking to acquire assets. Prices are up though in some cases. Market conditions, flat or declining market trends, or on the opportunity side, emerging submarkets or growth corridors. Generally, you're going to be able to get this type of information by studying the feasibility study that's been created. If you're on the investor side, you're going to want to take a look and see what the trends are. So what are the key tools for financial analysis? Well, the essential tools and the techniques are the Excel analysis, templates for pro forma rent rolls and expense tracking. Financial ratios, again, you're using NOI, DSCR, and ROI for quick evaluation. And market data resources, leverage local market reports and comparables. You can get an awful lot of free information on market, especially for larger markets, whether it's in Canada, United States, for example. It's all very transparent, it's all very open. Paid research, though, digs a little bit deeper into sort of niche areas. And that's something that is, I think, pretty valuable, especially if you're going to be investing in a few buildings that are 10, 20, 30 million dollars. You might want to pay for that paid research, and there's usually in each market a couple of professional groups that do that specifically for investors or real estate developers as well. So what would be your actionable checklist? Your financial analysis checklist would look at analyze rent rolls and operating statements, evaluate lease terms and tenant quality, review debt terms and contingency funds, identify deferred maintenance or capital expenses, and lastly, assess market growth trends and comparables. So now as we finish off, let's take a look at the verifying financials part, which is, I think, a really key part of the whole exercise. So part one in this page is number one, cross-check revenue data. For the rent rolls, you want to match tenant names, lease terms, and payment histories to bank statements. Projections, you want to compare projected income to market comparables and adjust for realistic occupancy rates. So those are two key things. You're going to want to make sure you're going to see, especially if it's a commercial building, let's say it's an office building in a downtown major place, New York, Toronto, Miami, any of the areas, you're going to be able to identify some of those companies and say, okay, well, these are great companies to have in there. Hopefully we're going to have them in there. It's really, really important. I can tell you that after looking at commercial property disposals when I was working in Dubai, it was very difficult because you had a whole bunch of companies that weren't necessarily well known, and when the financial crisis, global financial crisis happened a number of years ago, we were looking at developers or owners of buildings who wanted us to help them sell. So we, as the exclusive party involved in the sale process, would have to look all over the rent rolls. And the main concerns we had is we had some buildings, let's say the commercial building, smaller commercial building with maybe 75 or 100 offices. We find sometimes 30 or 40% of them were related to the real estate industry. Well, we know what happened back then. The real estate industry was one of the, right after the banking, was one of the first industries to absolutely collapse. And overnight, some of these real estate companies would just leave, lock up their doors, sometimes just even leave the country and not pay their employees. So you have to have that's why a really good mix on the commercial side is really, really important. Same with having a good mix when it comes to residential type of rates and loans or time periods. Sometimes it's good to extend 3 or 4 years to a tenant that might have been there for 20 years. So again, by looking at the financial state analysis and the financials on Excels, that person may not know the real story, and that's why it's really important to go in and try to match things up, because at the end of the day, whoever is doing the financials as the team that's going to be helping to sell, I have to come in with the story of why these numbers are like that. So an awful lot of time. This is all part of the due diligence that is not only done by the seller, but will happen to be done by the investor. Number 2, you're going to validate all the expense records, request invoices and receipts for major operating expenses. Compare reported expenses to industry benchmarks, especially when it comes to maintenance and property management. I've seen some horror stories of property management firms that have been on the project for 10 years, and the rates are completely out of whack compared to what's available currently. Confirm financial statements, so the operating statements ensure alignment with audited financials or tax filings. Check for consistent reporting over multiple years to identify anomalies. And inspect the loan documents, review loan agreements for interest rates, covenants, and amortization schedules. Ensure the debt balances match amounts reported in the financials. Now let's move on to part 2 of the verifying financials. Number 5, third-party verification. Use appraisals and market comparables to verify valuation claims. Nobody's going to believe your own numbers, so your own numbers can be partially believable, but back them up with what's happening, and again, you may have to pay for that type of research. At the end of the day, an appraisal is kind of research, but I like to include the detailed research that may be based on the area or that asset class by a third party. And some of those reports cost hundreds of dollars and some of them cost thousands of dollars. So again, you're engaging independent auditors or accountants for unbiased evaluations. Number 6, check for contingencies and reserves. You're going to confirm the presence of adequate contingency budgets and development projects. You're going to need that because you will run out of money as time goes on, and I'm counting out to that point of the one where I worked hand in hand with the developer. We were a two-man team. The developer had purchased the land and we were working together to get this project on the road. He had to have a large amount of money set aside because every single thing, every delay, every month that we had to wait for something was costing him interest on the loans, my time as a consultant, keeping a advertising agency on retainer, keeping the architect on retainer. If you have to stretch that out 9 months further, well, you're talking tens of thousands of dollars on top of your original budget. So again, those are really key. Number 7, scrutinize the lease agreements. Again, for acquisitions, you want to verify lease terms, escalation clauses, and tenant payment histories. You want to look for risks such as pending lease expirations or a tenant litigation. Number 8, you want to assess market data, compare revenue assumptions against local market trends and absorption rates. And lastly, you want to verify demand drivers, population growth, and employment rates. So as seen in my earlier videos, when we're talking about, well, what's the timeline to either sell assets or raise capital for them? Well, it's always going to be longer than what the party that you're working for, if you're the fundraiser, wants. He wants everything done next week. He's saying, oh, Joe just sold his building in 3 months, and Smith down the road, he sold 30 buildings to a large private equity firm, and it only took him 6 months. You can't use that. Everything has a process. There's a step every way, and I like to tell people when I get involved in the project, I say, factor in 6 to 9 months minimum, but in reality, expect to get a check in 12 months. And then, so you set the, and that depends on the project complexity, investor responsiveness, and external factors. Those timelines start really from the time we do our kickoff meeting. So that's a good way to set things up so that both parties can start to plan, because every single step in the process must be done or you're not going to have a successful venture. I hope you enjoyed that video. Just a quick bit about myself. I'm a fundraising strategist with 15 years of experience in high-end real estate sales and marketing spanning Canada, Dubai, and the Caribbean. And over the last 3 years on Fiverr, I've assisted over 300 clients with startup fundraising, pitch deck refinement, investor outreach strategies, and custom investor databases. In addition, I serve as an advisor to a New York-based private equity firm with a capital commitment of $10 billion. This capital is strategically allocated to projects across the Middle East, Asia, and the USA with a focus on income-generating real estate. The firm offers both debt and equity financing with investment sizes ranging from $10 million to $100 million per project. You can get more information about my background and services by clicking my Fiverr link below. Thank you for watching this video. Please like, share, and subscribe.